Hello and welcome back to Lipper's Fund Flow Insight. My name's Matthew Lemieux. We're going to be looking at weekly fund flows for mutual funds and ETFs for the week ending May 8th. So once again, we're coming off of a pretty strong week. You know, the week started with the Fed coming out and reinforcing its commitment to the market. On top of that, we saw better than expected non-farm payroll numbers. And then roll into this week, what do we see? Dow at above 15,000, S&P continuing to set records, and we're seeing the Nike as well as the German DAX following suit. So overall, it seems that the equity markets are doing quite well. We're grinding up over and over each week, despite, again, a lot of analysts putting some concern out there that maybe this rally is running a bit too hot. But let's see how, as we get into the summer, how this optimism in the market really kind of translated into fund flows. So if we actually look at the overall macro groups, this week was a big week. Overall, we saw about $22.7 billion in net new sales coming into this group. Of course, if you look at money market funds, 16.5, a real big portion there, but still strong sales across the board. Equity funds brought $1.8 billion in for the week. Taxable bonds, 4.4. Munis were basically flat with about $18 million out. So, you know, as we talked, you know, equity markets are looking strong. There is a lot of concern out in the markets out there that how long this rally is really going to continue. But I think there's a lot of pressures to find yield and returns, as well as, you know, investors being pushed to riskier assets based on really what the central banks are doing. Don't fight the Fed. We hear a lot about that, and I think it's really holding true that investors are continuing to move to risk assets, and the markets are doing quite well because of it. So let's look at equity in general. Like I said before, $1.8 billion in net inflows. That's the 18th consecutive week for equity mutual funds. And really, again, investors really were looking at non-domestic more than domestic. Again, money in both places, 1.1 into non-domestic, really half split between emerging market type products, and the other half split between international multi-cap core, or just kind of your general broad market, non-US broad market products. Domestics about $706 million in. So both pretty good when it comes to equity mutual funds. We continue to see investors going to that group so far this year. They've continued to do quite well. Now let's talk about the other side of the coin, which is the equity ETFs. If you look at equity ETFs, we saw about $5.9 billion in net inflows. Combine that with mutual funds, a pretty strong week, $7.7 billion. It's the strongest we've seen since March 13. On the ETF side, really, again, a lot of the net inflows came from SPY, $5.4 billion in, but also PowerShares Triple Q did quite well, $750 million in. If you look at the bottom of the group, I would say that probably not the big surprise would be GLD, $1.1 billion. Gold ETFs continued to struggle. But the other thing is that we saw really two outflows of two similar products, IWM and UWM, both based off the Russell 2000. The PowerShares Russell 2000, the UWM, is a leveraged product and really used mostly by institutional. So it seems like maybe some selective bets and some shifts from one place to the other. We'll talk about that a little bit more coming up. So let's shift over to taxable bond funds. So even though we've seen all of this interest and optimism in the equity markets, investors continue to allocate new money towards taxable bonds. We've seen it the whole way. We never saw really the great rotation. Investors are really buying assets across the board, and it didn't change this week. $4.4 billion for taxable bond funds. This is the 27th consecutive week of net inflows for this group, and it's the largest we've seen since the first week of January. So if you look at the breakout, though, some of the stories remain the same. Investors really continued to focus on bank loan products, $819 million into that group. They really like the yield they're getting there, as well as some of the interest rate protection that comes along with those floating rate products. If you look at the year-to-date numbers, we've seen roughly $20.5 billion into that group, well surpassing any of the annual totals previously. Second, we see high yield funds. You know, high yield had kind of trailed off for some time when it came to flows, but despite the benchmark dropping its yield below 5%, we saw $691 million. Again, I think it's that yield story. A lot of investors really searching for yield, and because we're seeing so much optimism in the equity markets, I think it's kind of spilling over to high yield. And then once again, international and global debt did quite well, $649 million, and the vast majority of that really was going towards emerging market debt type products. So let's look again at the other side for taxable bond funds, which is taxable bond ETFs. $4.5 billion this week. It's a record since we've been tracking taxable bond ETFs. And if you combine the ETFs and the mutual funds, we see about $8.9 billion overall in the taxable bond funds. Again, a record on a weekly basis. And really what it was is that, we've seen the mutual fund side really kind of trade within that range, 4.4 this week, but we haven't seen this high of inflows into taxable ETFs. And really what it was is it looked like some selective bets on treasuries. Treasury products overall brought in about $2.5 billion, and it was really split between IEI at $1.5 billion and UST at $1.1 billion. Again, UST, it's the Power Shares Ultra Treasury, and again, it was interesting because I think that there was really kind of a trade-off between what we saw in the outflows from, the Pro Shares, what we saw from the outflow on the Pro Share side from the Russell 2000, almost exact amount of money coming in for the Pro Shares Ultra Treasury. So it looked like some institutions out there maybe were taking back some of their riskier bets and putting it in treasuries. We also saw some good flows into LQD, which is the iShares investment grade corporates. I think overall the story is that flows into fixed income ETFs are really becoming more of the picture. They're being more heavily used to trade and maybe take short or long-term bets. But really the inflows into treasury bond ETFs pushed up the taxable bond group overall to a record level for this week. Third group we're going to talk about is muni debt. I said about $18 million out for the week. This makes the 10th consecutive week of outflows, really flat. We've seen some smaller numbers in muni, not a lot of direction one way or the other. When we look at this group, the national muni overall was about $46 million out. But if you look at the short term, which is a part of that group, we saw $100 million in. And the reason I pointed that out is because in previous weeks, we had really seen a lot of the selling in the muni group coming from the short term. We actually saw some money coming back into short-term munis. And really where the money was coming out was from intermediate as well as high-yield muni. Single states brought in about $28 million, just to point out, because we are such in a narrow margin there between positive and negative flows. If you include ETF muni flows, we actually saw the first positive week within that 8-week period. Last group we're going to talk about is money market funds. As I mentioned before, we saw a lot of interest in money market funds, $16.5 billion. And maybe that's a little bit of that indicator is that some investors are seeing that this market's running pretty hot. I don't know if they're going to say quite yet that it's going to end, but they're maybe putting a little bit of hedge there, putting some money on the sidelines. Institutionals made up about $13.7 billion of the money market inflows, and retail about 2.8. This is the largest inflow we have seen this year. So again, not to read into it too much, but it did seem that, despite a lot of optimism and a lot of risk buying out there on both the equity and some of the fixed income side, we also did see some investors kind of taking more of a risk-off position with treasury bets as well as money going into money market funds. So, really, what are we going to see going forward? I mean, we're kind of getting into May. A lot of people talk about the old adage, sell in May, go away, summer doldrums. And I think it's going to be interesting to see how the markets go along. As I said, we've seen a lot of optimism in the markets, but even over the last few days, volumes have kind of dropped, and we're really kind of been grinding forward. So we'll see if that kind of is the theme throughout the rest of the summer. We did get through earnings season quite well, about 67% of the S&P 500 stocks coming in above earnings. But the interesting thing was only about 50% of them beat revenue. So again, the outlook is somewhat uncertain, but the demand for yield and the demand for risk and kind of the don't fight the Fed mentality keeps investors going back towards equities. So we'll see if that plays out through the rest of the summer. If you'd like a little bit more information about the numbers we went over, you can feel free to go to our website. It's www.lipperusfundflows.com. Otherwise, you can join us next week when we're talking about flows in the mutual fund and ETF industry. Once again, my name is Matthew Lemieux, and thank you for joining us.